There is an investment strategy so simple, a teenager with no financial education can use it. And yet, it beats 92% of professional Wall Street fund managers, people with Ivy League degrees, billion-dollar research teams, and decades of experience. No stock picking, no market timing, no skill required. But here's what makes this even more disturbing. The financial industry has spent decades making sure you never fully understand this, because the moment you do, you stop needing them. Every year, millions of hardworking people hand their money to financial experts, trusting them to grow it. They pay management fees, performance fees, and advisory fees, believing these professionals know something they don't. But what if they don't? What if the entire system of active fund management, the analysts, the algorithms, the quarterly reports is mostly noise? What if the smartest move in investing requires doing almost nothing at all? Today, you're going to find out exactly what index funds are, why they silently outperform nearly every expert on Wall Street, and the one critical mistake even index fund investors make that quietly destroys their returns. The final piece of this story is the part Wall Street hopes you never reach. Let's start with a number that should make you stop and think. 92%. That's the percentage of actively managed large-cap funds that underperformed a simple S&P 500 index fund over a 10-year period, according to the SPIVA report, one of the most respected performance studies in finance. Not 20%, not 50%, 92%. These are professionals, people managing hundreds of millions of dollars, people whose entire job is to beat the market, and they fail. Almost all of them, almost every time. But that's only part of the story. Here's what makes it worse. The ones who do beat the market in 1 year, studies show they rarely repeat it the next. Performance doesn't persist. It's mostly luck, and you're paying for it. The average actively managed fund charges between 0.5% and 1.5% in annual fees. That doesn't sound like much, but on a $50,000 investment over 30 years, a 1% annual fee quietly steals over $120,000 from your returns. $120,000 gone, not to the market, to the manager. And then something unexpected happened in 1975. A man named John Bogle had an idea so radical, so against the financial establishment, that Wall Street actually laughed at him. His idea? Don't try to beat the market. Just own the entire market. He launched the first index fund available to everyday investors, a fund that simply tracked the S&P 500, the 500 largest companies in America. No stock picking, no expensive analysts, no guesswork. Wall Street called it Bogle's folly. They said it was un-American, that it was settling for average, that no serious investor would accept mediocrity. But here's the twist they never saw coming. Owning the average turned out to be extraordinary. Because when you own an index fund, you own a tiny piece of every major company. Apple, Microsoft, Amazon, Google, Berkshire Hathaway, all at once. When one falls, others rise. When the economy grows, you grow with it. And because there's no active management, the fees are almost nothing. Some index funds charge as little as 0.03% per year. That's $15 annually on a $50,000 investment. Compare that to $500, $700, or $1,000 that an active fund charges for the privilege of underperforming. Most people completely miss this math, and this small detail changes everything. Let's talk about compound growth for a moment, because this is where the real secret lives. Imagine two investors. Both start with $10,000 at age 25. Both earn an average of 8% annually from the market. Investor A pays 1% in annual fees to an active fund manager. Investor B pays 0.03% in an index fund. By age 65, Investor A has approximately $198,000. Investor B has approximately $314,000. Same market, same starting amount, same time period. The only difference? Fees. That $116,000 gap didn't come from skill. It didn't come from timing. It came from one simple decision made at the beginning. But wait, the real reason this gets even more surprising is what happens during market crashes. In 2008, during the worst financial crisis since the Great Depression, most actively managed funds panicked. They sold, they restructured, they tried to protect themselves, and most of them missed the recovery. The S&P 500 dropped 38% in 2008, but by 2030, just 5 years later, it had fully recovered and reached new all-time highs. The investors who simply held their index funds through the crash, who did absolutely nothing, came out ahead of the vast majority of professionals who tried to be clever. Doing nothing was the winning strategy. And the final piece is the one nobody sees coming. There's a psychological trap built into investing that destroys even the most disciplined investors. It's called performance chasing. Every year, financial magazines publish lists of last year's top-performing funds. Investors flood money into them, believing the streak will continue. It almost never does. The top fund of one year is statistically more likely to be average or below average the next. Yet billions of dollars pour in based on past performance that is already over. Index fund investors are naturally protected from this trap because there's nothing to chase. The fund is the market. You're not betting on a manager's hot streak. You're betting on human economic progress over time. And historically, that bet has never lost over any 2-0-year period in modern market history. Never. So here's what we now know. 92% of professional fund managers failed to beat a simple index fund over 15 years. High fees silently destroy hundreds of thousands of dollars in long-term returns. Market crashes punish active managers more than passive investors. And performance chasing is a trap that index fund investors naturally avoid. John Bogle's idea, the one Wall Street laughed at, has now grown into a strategy managing over $15 trillion globally. The people who laughed are now quietly using it themselves. The most powerful investment strategy ever discovered requires no skill, no research, no market timing, and almost no money to get started. It just requires one thing most people find surprisingly difficult: patience. The market rewards those who stay. It punishes those who react. And the investors who quietly hold a low-cost index fund through every crash, every headline, every moment of panic, they are the ones who end up with more money than the experts who spent their whole careers trying to outsmart a system that was never beatable in the first place. The edge was never information. It was never skill. It was simply time and the discipline to let it work. So tell me, have you ever paid high fees to an active fund manager? Or are you already investing in index funds? Drop your answer in the comments below. I read every single one.